All right, welcome back. Today, we are going to dive headfirst into something that sounds a little intimidating, financial statements. But here's the thing. Learning to read them is like learning a secret language. It lets you see the real story of a business. And often what these documents don't say is even more telling than what they do. So let's get into it.
Okay, just let this quote sink in for a second. It's from a CEO whose company, well, let's just say it imploded in spectacular fashion. And it's so chilling because, honestly, it's true. Financial statements aren't just a bunch of math problems. They are stories, stories told with numbers. And just like any other story, they can be twisted and manipulated to hide the truth, to paint a picture that's just completely fake.
Take a look at this. This is a timeline for a fictional company we'll call Innovate Corp. In January, they're on top of the world, stocks at an all-time high. Then, fast forward to May, they're gone, bankrupt. Now, to the average person, this looks like a total shock, right? A sudden collapse out of nowhere. But for anyone who knew how to spot the warning signs in their financial reports, well, the cracks were showing long before the whole thing came crashing down. The real question is, how could you have seen it coming? Well, to figure that out, we've got to shift how we think about this. I want you to stop seeing financial statements as some kind of final exam or a math test. Instead, start seeing them for what they really are, a company's annual health report. This is the checkup that reveals everything. If a business is actually thriving, if it's just scraping by, or if it's secretly on life support. So what does a good health report even look like? Well, it all comes down to one word: quality. High-quality financial reporting is actually pretty straightforward. It just means it's truthful, it's unbiased, and it gives you the complete picture: the good, the bad, and yes, the ugly. It's all about building trust by being totally transparent so that you, the reader, can make a smart decision. Let me put it this way. Think of a high-quality report as getting a diagnosis from a really good, trusted doctor. The information is relevant, it's clear, and it's consistent year after year. But a low-quality report? Oh, that's from a total quack doctor. The language is designed to confuse you, the numbers feel like gimmicks, and the story seems to change all the time. One of these builds your confidence, the other just screams red flag. Okay, so we know the difference between a good report and a bad one. But how do you actually spot that quack doctor out in the wild? Well, now it's time to open up our detective toolkit and find out. This is the million-dollar question, isn't it? How can you tell when a company is trying to pull the wool over your eyes before it's too late? Well, the good news is that companies hiding something almost always leave a trail of clues. You just have to know where to look. And here they are, 4 of the biggest red flags you need to watch out for. First up, profits are going through the roof, but the company's actual bank account is draining. You have to remember this. Profit is an opinion, but cash is a fact. Second, the reports suddenly get filled with dense jargon and confusing footnotes. If they can't explain it simply, it might be because they're hiding something. Third, they keep changing their auditor. That's the outside firm that's supposed to check their math. That's kind of like firing your doctor right before you're supposed to get a major diagnosis. And finally, number 4, and this one is a biggie, they get really creative with how they count their money. Let's break that last one down for a second. You'll hear this term aggressive revenue recognition. It sounds super technical, but the idea is actually really simple. All it means is that a company is counting their chickens before they hatch. They're recording a sale before the money is really, truly in the bank. So imagine a company signs a 3-year contract, but they book all 3 years of that revenue on day 1. It makes them look amazingly profitable right now, but it's not real. It's a mirage. And believe me, this isn't just some small-time accounting trick. A staggering 70% of major corporate frauds involve companies playing these kinds of games with their revenue. It is the absolute #1 way they try to cook the books. So, why did we just go through all of this? Because learning to spot these red flags, it gives you a kind of financial X-ray vision. Seriously, it empowers you to see right through the hype and understand what's really going on with a company's health. And that can protect your investments, your career, your future. And if you need proof, look no further. The data is crystal clear. Companies that are committed to high-quality, transparent reporting, they consistently show stronger, more sustainable growth over the long term. It turns out that honesty isn't just good ethics. It's an incredibly powerful business strategy. Deception, on the other hand, is a short-term game with a very painful and very predictable ending. So let's quickly recap what we've learned, the big takeaways. First, always remember that financial statements are telling a story, and your job is to be a critical reader. Second, quality is all about truthfulness and clarity.
Next, always follow the cash, not just the profit. Be deeply suspicious of unnecessary complexity. It's often a sign something's wrong. And maybe most important of all, your knowledge is your absolute best protection against being fooled.
So in the end, every number, every footnote, every single report, it's all part of a larger story. The question isn't whether you can understand it anymore. The question is, are you ready to really listen to the story the numbers are telling you? Thanks for joining me.